the question was, who else saw this coming? Who saw this coming? And a year ago or so, Silicon Valley Bank stock, and don't go to the chart just yet, I'm gonna call for the chart in a minute, was at 725. Before this past week, when all the fun started, the stock was at about 300. One day, I think it was 327, but right around 300. And you had two things. One, think about that. They had lost 400 points in a year. You had Moody's knocking at the door about their rating. So stuff behind the scenes was happening at Silicon Valley Bank. You had long-term customers saying, you've never invested in systems. I'm getting frustrated with you. You had a couple long-term customers come out over the weekend and say, you know, we had actually already moved our accounts away from Silicon Valley Bank. So we here at this private equity firm, and I'm not going to say the name, but there were two significant private equity firms that had actually, in January, February of this year, fired Silicon Valley Bank because they couldn't provide the services that they used to. They hadn't updated all their systems, and they were done with it. And banks like Mercury.com, and by the way, full disclosure, neither myself or Pat have any investor interest in Mercury.com at all, but that is not a plug. But we, through Valuetainment Investment Group's PE firm that Pat founded, that I'm partnered with him on, we reached out and they use Mercury.com. And so we sent out an investor note this weekend telling people, hey, everything's cool. We do not use Silicon Valley Bank, so all the investments and things you've made and the companies that we've invested in, that you're in with us, you're cool. And they were very happy to hear that. So you have all the stuff going on, Mercury.com getting a little bit of traction. You've got some people actually firing Silicon Valley Bank January, February, and you've got a stock price that lost 400 points this year. And with all that backdrop, Jim Cramer, Mad Money, comes out and says he thinks at 300, 320, he thought it was a buy. And we've all seen the clip, it's all over Twitter, but I don't think what they understood with everything that was happening. As a matter of fact, there was something else. The Dow Jones News Service actually did a review of like 110 banks or so, and I'm gonna scramble the eggs on this, so let me be very careful. And they were looking at the net margin for the bank, which is a measure of banking strength. And they had shown of these 110 or so banks that there had been a significant number had a net increase in net margin, meaning as interest rates went up and stuff, they were managing themselves accordingly and achieving higher margins. But there was a list of 15 to 20 that had contracting margins, which is a bad sign. So if the greater part of the industry is seeing this progress, and there's 20 down here seeing a compression of margins, it's a red flag. Guess who was number 11 on that list of banks that were having trouble? Silicon Valley Bank. And you had no less than, let me get it, it was, yep, it was Dow Jones News Service, Philip Van Dorn, and folks there that had done significant research on it, and they found that. So with all that going on, Cramer comes out, and by the way, this is published, that was published March 11th. So Cramer was ahead of that. But things like that were in the market and available to be seen. He comes out and said that. I'm going to teach you something now. Do you have the picture of the dead cat bounce? So I'm going to teach you what a dead cat bounce is. And I think most people know it. Everybody looking at that now? Give me a thumbs up if everybody's looking at it. Yep. So this is a dead cat bounce. So as the stock is going down, there's a sudden moment where it pops back up and people think, hey, maybe the bear market's over. Maybe the crash for the stock is over. And you see the little red arrow? Investors get trapped here. They buy in, but what happens is the stock just then soon continues the downward spiral. This is called the dead cat bounce. That's what it is. You can look it up on Investopedia. It'll tell you all about it. What I want you to do is now take a look at the last 3 years of Silicon Valley Bank stock. Let's see if we can get that whole thing on the page here. So looking at this now, give me a thumbs up when the viewers, everybody can see it. All right, everybody look at this. Take a look at their 2023. So you can see there's the 700 right at the start of end of 2021, start of 22. 725, I think this peak was 727. 400 points are lost all the way down 327, which was a dead cat bounce. Look at that. In February, March of 23, look at that. That is a textbook dead cat bounce when Cramer says, yeah, you know what? I think this is good. And so the bonds on the balance sheet are a ticking time bomb. The dead cat bounce happens, and then you can see, we all know what happens on Friday, the 10th of March. It's over. And the regulators come in and it crashes. So now we see that and we see why it happened. You know what? Without a chief risk officer and making decisions like they did, and there have been a lot of things written over the weekend, and I'm one of them. I just wonder what you were thinking. You know, at a time of volatility, if you can't hold to maturity in the event of a crisis, why on earth would you put that kind of money in? And the answer was Silicon Valley Bank was trying to squeeze a little more yield out of the deposits, which led them to put that in place. So what's the lesson for us, and what can we do? I've got a few things I've shared along the way, but over the weekend, I got an email that I'm going to read some things verbatim. And this is from a significant private equity firm where I was provided, cannot provide the name, can't quote any individuals here, and there's nothing inflammatory, but this is what they did, and this was their discussion of it. And let's take the lessons for you and me. If you're running a company, part of a company, here's an important lesson. If you don't have your own risk management meeting once a year, and the recommendation is to do it about the time you're preparing your taxes, because you probably have extra an accountant is working with you at that time. So even if you're a small company, you do your own books and QuickBooks, maybe you have someone who's a part-time financer or accountant or something, or a bookkeeper, you still probably have somebody professional filing your taxes. At that time, it's a great time to do a risk assessment and look at who are my biggest vendors? Who is Plan B? You know, it's very interesting. We sat through this about 2 years ago before the sale of PHP that Patrick talks about, the insurance company he had in Dallas. And he said, after we had a blip that was not our fault on the IT side, and it was a key vendor that had a bad weekend and it impacted us. And Pat said, do we have cell phone numbers not from their helpline, not from the helpline manager, not from the director of ops, but the frickin' chief revenue officer responsible for our account, and even the CEO or their president or division president? Do we have those? Do we have Plan Bs? And there was a revised risk assessment that we did inside and went and added to lists and things that we had to make even more granular and more ready for these sorts of issues. Listen to what this private equity firm said about both SVB and what they were doing. First of all, we've been working with SVB for 35 years. And there are stories emerging that, suffice to say, are not the actions of the SVP we grew to know and respect over the years. So once upon a time, they had a powerful partner, but what they're hearing is not what they originally got in business with. In fact, after they mishandled a couple things within the past 2 months, we've actually closed our corporate account and we've already transferred to someone else weeks and weeks before this debacle hit. The fundamental premise we have is this. We are now setting up checking accounts with 2 different banks. That's in case we have to move things quickly. And we need to encourage our portfolio companies to do the same. A main checking account and a backup checking account. Maybe segregate payroll and a couple operating balances like rent onto the second one, but always have 2. That way, we always have a live backup. We need to be extremely careful when selecting these two banking relationships. Maybe two regionals is not the way to go. Maybe a big four and a regional. Suffice to say, thought has to go into this. And we need to sweep all, and I mean all, excess cash for working capital and share with our portfolio companies that perhaps the strategy is just to buy 6-month T-bills every Monday at common auction. That way you're protected, but you're also prudent. And let's all monitor the FDIC and the regulators' announcements this weekend to see what requirements are going to be placed on banks and what things we can do. If our 16th largest bank is able to make massive bad bets with our money, then maybe other financial partners we encounter will do the same. I hope not. I pray not. But it's time for us to be prudent and not trust unilaterally with concentrated risk on our banking partners. It's the same thing we talk with our portfolio companies about concentrated risk when it's time for them to sell or be acquired. And I'll talk about that in a minute. But also, let's look at overconcentration on our own. Powerful. So this is a managing director and co-founder of a PE firm that you see what he's saying. Wow, let's step back and look at things a little bit. Are we risk managed, or have we just been going along with the same partner for years and years? They had an experience with SVB at the beginning of the year, and they'd actually moved just the PE firm's accounts away, so they were unaffected. But he's sitting back saying, wow, that was a prescient moment. Incredible. So here's the thing that's strong for us, is we need to take a look at the things that matter. And the things that matter is risk assessment. The things that matter is protecting yourself. And the things that matter is prudent reevaluation. You know, once a year, companies will have audits. And the board wants to read that audit every year. We, at companies I've been involved with, have done that. And the audit was like my report card of companies I was CEO of to the board. They knew me. They're meeting with me on a quarterly basis. But at the same time, that audit was an opportunity to see if there's things I need to change. Well, similarly, audits need to be internal beyond your financials. Auditing where your risk is, who you're trusting, because things change. Silicon Valley Bank went years and didn't upgrade their systems, and it started to bite them. They went years with having a full staff and then went 8 months without a chief risk officer? Are you kidding me? I don't think in life insurance, I think with insurance carriers, I don't know if regulators would allow you to do that. And I have some experience with life insurance, having the privilege of working for the company that Patrick founded for many years. And so you step back and look at it and go, oh my goodness, how did this happen? But for us, whether you're running that t-shirt company in Berlin or a technology startup here in the US, you have the opportunity to avoid these things and learn the lessons here so that when the headlines hit and you call your COO or your VP or just your business partner, if you're a small firm, you say, it's okay, we already have plan B, it's right in the folder, it's our risk folder, we have a plan B, we've just moved this around. And especially if a big tech private equity company is talking about having 2 key checking accounts, like one just for rent and one for payroll and everything else, maybe you should do the same. Yeah, there'll be a monthly fee, but you're also putting yourself in a highly protected position in the case of uncertainty in the banking industry. Likewise, insurance companies. Who's your plan B? If your insurance company called you tomorrow and say your general lines policy is doubling because we don't want to do business in construction anymore, who's your phone call? You have to figure that out. Don't do it on the fly when you're up against the limit and you're probably going to get the best negotiated price. Already have it. And I think that's the lesson for today. And I think that's really what I wanted to talk about on today's podcast, was about protecting yourself. I hope the information was helpful today. I appreciate you watching. Special thanks to Valuetainment that brings this to you on the Valuetainment channels that are up there on YouTube and syndicated through Apple Podcasts, Google Podcasts, Stitcher, Spotify, and wherever great podcasts are heard. You will find the BizDoc podcast every Monday, brought to you by Valuetainment. Until next time, I'm Tom Ellsworth, the BizDoc, and I hope I left you better than I found you.